Hello and welcome back to Golden Arch Investing. Today is Thursday, December the 5th, and yesterday there was all sorts of big bank earnings. And actually it's been going on basically the whole week. For me, I want to talk about the three Canadian banks I'm personally invested in, tell you a little bit about what happened in their earnings report, tell you what it tells me going forwards into 2025, and to talk a little bit about how this either reinforces or might invalidate my actual investment thesis. So we're going to go through in order in this video: RBC stock, National Bank stock, and EQB stock. If you're interested in any of these three, please check the timestamps in the video below. I'll let you know exactly when we get to each. Welcome back to Golden Arch Investing again. My name is Liam. We talk about Canadian investing every week on this channel. And let's dive into RBC's Q4 results. So on the screen in front of me right here, I've got the investor slides from RBC directly. And we're going to go through a couple of things. Now, I do want to point out RBC was up on this news just a little bit. It is RBC. They outperformed what people had expected. So expectations were a little lower than where they came in. And they seem to know it, right? They seem to say that, hey, we're doing a good job. A couple key points here, right? There's a lot on this page right now. We're looking at adjusted EPS of 3.07, so $3 earnings per share. That's great. Reported is obviously a little bit lower than adjusted, but that's just sort of the world of banking here. Wealth management, that's growing fast. I'm really impressed. They're talking about core expense growth. That's pretty normal. They're talking about basically the increase in personal banking, excluding HSBC. So even their core business is growing. It's not just growth through acquisition here. Really quite strong capital position, well above where they need to be as a big Canadian bank. So that's what this ratio is, the 13.2. They don't need it to be that high to keep up with regulations, but it's really nice to see it. As we keep heading down, you'll see we have some year-over-year growth in a whole bunch of different sectors here. Loans going up, not great for the economy, obviously, but good for RBC. And they seem to be keeping their book strong. They seem to be confident. I think it's really interesting. The next sheet here is their objectives. I think it's really interesting. They talk about wanting to basically like get their ratios where they want them to be, and dealing with sort of the potential threat of having the loan book increasing quite as much as it is. Obviously, the Canadian economy isn't doing great. Now, the U.S. economy is. So their U.S. business is doing great, sure. But the Canadian economy hasn't been doing awesome. And so a lot of these loans might not be from quite as strong of a borrower as they had been in the past. Mortgages are tough to come by, but they did have new rules come out in the last little while, right? Where you can get the 30-year mortgage, new rules about, allowing more people to access 5% down mortgages and more expensive homes. So maybe you could argue that increased some of their loan book. But anyways, they did, however, not meet their own medium-term objectives on EPS growth and return on equity. So they're aiming for 16+%. They're saying that their average adjusted 5 years over that, but their average reported is below that. Interesting to note. Net income, honestly, just strong growth across the board. I talked about how wealth management is growing fast. Their U.S. full-service wealth advisory firm looks like it's doing well. I would guess, based on what I have in front of me, that's the main driver. They also have a strong mutual fund share here in Canada. I don't think that's necessarily great for Canadians, but it's definitely great for them. Capital markets, they're up to the 10th largest global investment bank by fees. It's kind of an interesting way to measure yourself, but okay. Insurance, they're saying they're number one in creditor protection. They're saying they're number one in commercial lending, number one in residential mortgages. Again, so there's lots of little growth in a couple of these areas. Really strong growth in insurance, really strong growth in wealth management. Good to see. Now, one thing that is really interesting, they bought HSBC Canada, right? That was a big news story a little while ago. It sort of has gone through now, and it's interesting to see where they see things going. They're saying they're at about 30% of the synergies they believe that they can get. They say that by March of 2026, they're hoping to achieve 100%. March of next year, they're saying they're going to hit 60%. So interesting. Solid earnings are still on track. Again, diversified business model, talking about their CET ratio. So what do I think about this? Well, I think they're showing that they're still growing. I think they're proving that having this diversified business model is awesome for them, and they're able to grow in all sorts of different areas, right? I think one of the big stories over the last year has been Canadian economy is not doing great. The Canadian consumer is suffering. The average Canadian doesn't have the same amount of money as they did. Now, being a big bank, that can benefit you short term, but it's going to come with big consequences, because if a lot of people are taking on debt they can't afford, then companies like this are going to be in trouble if they don't pay it back. I think, however, RBC is in a great spot because of their access to that American market and because of their just position, right? They've done so much to put themselves in a position to be successful. They, this wealth management business is a fantastic business to be in their position in. Even insurance, right? Like, people don't probably have the same kind of brand loyalty to insurance as they might have. Big corporate clients do a lot of the purchasing there. If RBC can steal a couple more big clients or keep, driving insurance growth, it'll be awesome. And obviously, it's 30% plus compound annual growth on things like that, right? So if that part of the business is going to grow 30% plus year in year and year on, that would be really, really impressive. So that's about all we have. Their actual numbers, I don't think are dramatically important for us because, like I said, we know they outperformed, and it's RBC. They're going to keep outperforming. They're going to keep outperforming for basically the rest of time. The only thing I would say, if you want to look, PCLs are going up. I think that's sort of to be expected. Again, we've talked about the market that we're in. However, it doesn't seem to me that it's going to be sort of the end of the world here. They seem to, you know what, I just believe that this company is going to be in a position where they can deal with it. And yeah, so RBC, again, I'm pretty happy with where they're at overall. I think they've managed to keep growing while keeping their risks low. And I think they're just the number one player. Their size alone gives them such an advantage. It's huge. So I'm going to jump over to the National Bank presentation now. Again, I have this up on the screen for you guys. I have it on the screen in front of me here. And we're going to go through, again, a couple of things. I want to compare these two because National Bank and RBC are a lot closer together. They do have a good bit of separation, which is why I'm invested in both, but they are a little bit closer together than any of them are with Equitable. And so I do want to talk a little bit about how National compares to Royal. Again, let's talk about a couple of key things. So they're looking at that mid-high single digits growth. They're putting their return on equity. And if you remember, we were talking about RBC aiming for 16%. They're putting theirs reported at 17.2. RBC's reported was in the 15s, but their adjusted is actually lower. RBC's adjusted was higher. So interesting. PCLs, again, it's going up, but it's in line with guidance. They expect it to go up. And their CET ratio, again, very close to RBC, 13 point something. And again, this is 13.7, and they're in a pretty good spot. They're saying their dividend payout ratio is in the 40% area, which is good for them. Love to see it. They talk about revenue. they're looking at year over year growth, 15%. Again, provision for credit loss, we looked at a 30-ish% for RBC. They're looking at a 27%. Honestly, it's going to happen in an economy like this. These guys are even more exposed, I would argue, to the Canadian market than RBC is. But they've done a really good job of avoiding some of the really hot spots just by being a Quebecois company, to be honest, and having that sort of focus in that Quebec market. They've dodged a little bit of the bullet of Toronto and Vancouver, where you've had particularly mortgage loans that have just like dragged people down. And of course, cost of living is just insane in those cities. Not to mention the like condo crisis and developers failing, all sorts of stuff going on there. Hey, a couple other things here. So solid momentum across all of their business segments. Again, we're looking at like wealth management and F&I, which is again a lot of the same kind of things we had talked about earlier with RBC. These are their real growth areas. Their financial markets is actually down. Tough. Personal and commercial banking is up single digits, right? Like could almost be the same. One thing I will say, wealth management is not growing as fast as RBC. Probably, I haven't dug too deep into the numbers here, but I would assume it's because one, less of a well-recognized name. You don't have that same kind of respect with a 6th place player that you do with a 1st place player. And so they can't really be demanding the same kinds of, corporate interest. They can't be getting the same kind of hedge fund interest, right? They won't be able to offer the same size of loans. So there's a couple of things like that. And also probably more exposed to Canada. From everything I know about this company, I would assume that they're more exposed to Canada than RBC. Obviously, their US F&I doing a little bit better, but so is the whole US economy. So financial review, a couple more things I want to point out, right? We're looking at revenue growth in that sort of 15% range. Awesome. They're talking about efficiencies. That's great. I want to see if they'll talk about CWB on here. That's what I'm kind of scrolling for. They talk about PCLs. I love, is this Jean, who is the chief risk officer? I don't know how to say, I might get this wrong. Jean-Sébastien Grisé, maybe. But just love what he's doing. Love it. Love National's risk management. Again, they dodged Toronto and Vancouver like mortgages mainly, which is huge. But they've done a really good job of not having this PCL number explode on a growing bank that is not the number one player that has the sort of option to say no, right? They're trying to grow, and yet they've kept it down. They kept it down better than RBC. I personally believe they're in the best position when it comes to PCLs. Yeah. Okay, they're talking about their gross impaired loans, right? I mean, I don't think any of us are shocked that number is going up. More people aren't able to sort of pay off their bills. More companies are put in a position where they don't have the money to actually pay off the mortgages and big debt purchases they made. And yeah, again, look at that. Look at that exposure to Quebec. Pretty awesome, I think. Okay. Yeah, I don't think they're going to talk about CWB on here. It doesn't seem, just because obviously the acquisition hasn't gone through. So they haven't talked about what they expect will happen. They do talk about some macroeconomic scenarios. That's interesting to me. They're guessing that the GDP is going to slowly rise, but at a faster rate in the next 2 years than it has. And that unemployment's peaking Q1 maybe of next year. Sorry. I think that's really interesting. They're guessing WTI is going to be in the same range, high 70s to 80s. That's not bad. Yeah. All right. Super interesting stuff. So Spark notes here for everybody. National Bank doing a little bit better on a couple of key metrics than RBC, but obviously not quite as big a position. And so While their wealth management and those other sectors like USS F&I are growing quick, they're not growing quite as fast as RBC's wealth management, RBC's invest or insurance sections, just because they're not in the same kind of American position. That's what I'm getting from this earnings report. So RBC is really benefiting from being a Canadian bank, that has huge American segments. So we're jumping over to EQB. Very different, right? Very different bank, these guys. So we should be seeing some pretty interesting differences here. They switched up their fiscal year last year, so interesting to note. And let's scroll down. So some full year 2024 financial highlights. Look at that return on equity. That's almost exactly where RBC hit, but these guys are reporting lower and adjusting higher. Their revenues are up a good chunk. Their quarterly dividend is up 23% year on year. I like that. And look at that diluted EPS, right? That's a number that is shocking. Diluted EPS of 11. What did we talk about it with RBC? It was $3, something like that. Single digits for sure. Diluted EPS in the 11 range is awesome. Awesome to see. Okay, couple more things. So they're talking about PCLs. These guys are talking about 40 basis points. So earlier we were talking about 30. Now we're talking about 40. So for the full year, sure, it's not growing quite as quick, but in the shorter term, it's growing quite a bit. Their impaired loans are up a good bit, right? So there are definitely got some loans that are under stress. I believe, and yeah, I'm looking at the numbers here. I don't believe that they have quite as much mortgage exposure as some of these other banks, but they got some big equipment financing loans, some big commercial loans, right? So companies are still under stress from all the same things that people are. So that doesn't necessarily sort of shield them from the same kind of risk. They're talking about some other things. So multi-unit residential loans are up. Awesome. That would be, I guess, in commercial. Couple other things there. Love to see it. They talk about some of their things, some of their products that have grown. Love to see that, right? They're mentioning like specific products. So notice savings, huge this year. The whole notice savings account, right? Where you have this higher interest rate that you get on your money, and you basically are like almost in a GIC until you want your money. And then there's just a couple of hoops to jump through and you can take your money out. They're over 9 billion in deposits, 500,000 Canadians at the bank. So they're growing quickly. They have so much room to grow, right? 500,000 Canadians, you'd argue, like, what is their target demo? It's probably the millennial Gen Z Canadian, right? That number is a lot higher than 500,000. So there's all sorts of younger Canadians that might end up doing some sort of business with EQB. They also are working with some small businesses. Again, probably small businesses ran by the same kind of generation of people, I would assume. They got some growth guidance for us here in the medium term. Love to see that. They're looking to get their return on equity up to that 15 to 17% range. So they're actually saying that the midpoint of their range is going to be exactly where RBC is, which would be really impressive to see from a growing bank that, again, doesn't have this kind of exposure to the US that RBC does, and this access to these huge products that can make these banks so much money. They're looking at pre-tax income growth rates, again, 12 to 15%, diluted EPS growth rate, 12 to everything is going to grow by 15%. That's what they're saying. Expect the stock price up, I guess, 15% next year. That's their hope. But yeah, they're hoping for book value per share to grow by 13%. And they're saying, hey, we're happy with where our leverage is at. Our loans are going to grow a little bit slower than our 12, 15%, but we're going to get everything else up a little bit faster. So love to see it. Couple of things in here. Again, we talked about return on equity. We talked about that diluted EPS. Maybe that was a full year number versus a quarterly number. Maybe that's a mistake on my part. Because they're showing a 2.5 versus an 11 adjusted EPS. I think it's interesting. All sorts of interesting stuff. Okay. Net interest income over $1 billion for the first time this fiscal year. Margins are up by 10 basis points. Cool to see. Personal commercial banking is up a percent. Okay, fair. And 9% year over year. That's their loans under management. Strong wholesale funding channels. Really strong non-interest revenue. Right? Average monthly non-interest revenue is up 55% compared to last year. Holy. That would be awesome to see, especially if you're someone like me who's hoping to kind of see these guys lean into the whole, provider for fintechs and, be the bank that backs, these fintech opportunities in Canada. Non-interest expenses up a little bit, sure. And yeah, and they're looking ahead. Again, they want that 15% ROE. I think this is where we're going to sort of cut it here. EQB is a whole different business, in my opinion. Yes, they are a bank, and yes, they're growing at the same kind of rates as the other banks, and they probably could, over time, end up in the same kind of position as other banks. I think their real strength is in their position as a digital provider, digital financing provider. They could be the bank that backs fintechs all over Canada. I think if they position themselves correctly and they keep sort of pushing, being the, Canada's digital bank, they could probably do some really cool things. So that is my thoughts, just going through the earnings from these three companies that I do personally hold. These are companies that I'm personally invested in, companies that I personally care about. And those are my thoughts, sort of giving you an overview of what I believe sort of is happening with them. Now, does it change my thesis? Did I see anything in there that changed my mind about any of these companies? And honestly, no. RBC is my largest banking position because I think they're the number one player. They're a really strong compounder and they are growing fast, right? They have a lot of parts of their business that they're able to continually grow, right? We saw high double digit, right? In the 30 kind of % range growth on some of those segments. I think they're going to keep growing it quickly. National Bank is in a great position because they've avoided a lot of the financial pitfalls that a lot of other banks have fallen into. They're probably positioned better if things go bad in the Canadian economy in the short term. And they've been growing the fastest over the last little while. They're acquiring Canadian Western Bank next year. I think that'll be huge for them. I just think they're in a really nice position. EQ Bank. They can basically perform the same as these other big players, even with such a small profile, because of their position as this digital bank. If they do manage to get themselves in a position where maybe they're financing fintech startups or they're sort of following the SoFi model, I think they could be in an amazing position going forwards. And if they don't, they're just another bank that's growing just as fast as the other ones, if not faster in most segments. That's my thoughts. My thesis is pretty much supported by these earnings, and I'm going to keep dollar cost averaging into these businesses over 2025. I am excited to see what kind of things come for these companies. And let me know your thoughts down in the comments down below. If you made it this far in the video, you're interested in my thoughts on these three companies, please leave a like, subscribe to the channel, and let me know, what other companies should I be looking at in the near future? Do you think there's another bank in here that I'm overlooking that might hit my goals of basically having a big traditional bank player and some growth plays? One obviously a little bit more speculative than the other, but big player, growth plays. If there's another financial company that I should be looking at that maybe has the opportunity to grow their dividend faster or hit another one of these segments that I'm interested in, let me know. With that being said, I hope I see you in the next video.